The following paid commercial program is brought to you by TD Wealth.
Tonight, triple-digit moves for the Dow seem to be the norm these days. Will the volatility continue? And do you have a strategy to manage your assets through market turbulence? Jean Masson, manager of a suite of TD low volatility equity funds, weighs in. Then, later, it's the season for crystal ball gazing. John Malden, New York Times best-selling author and chairman of Malden Economics, will share his 5-year global financial forecast to take us to the end of the decade. That's coming up on Money Talk.
Hello there and welcome to the show. I'm Kim Parlee and I'm really glad you could join us tonight. As you just heard, triple-digit market moves, they're the norm these days, and today is no different. The TSX was up over 250 points today, courtesy of a surprise rate cut by the Bank of Canada. So just how could this Bank of Canada rate cut impact the markets and the Canadian economy, and how much more volatility is coming? Joining me from Montreal is Jean Masson. He is manager of the TD Global Low Volatility Fund, which is the largest global equity fund in Canada, plus a number of other suites of low volatility funds. Jean, it's great to have you with us.
Nice to be with you, Kim.
Let me start off with this rate cut by the Bank of Canada, and I couldn't have scripted this better if we were talking about low volatility and volatility today that's happening. The headline I was just reading actually from a currency trader is, my jaw hit the desk. Nobody predicted this was going to happen.
And I wasn't one of them either.
So how much, I mean, tell me a bit more about just what you thought of when you heard this. And also, I mean, we heard from the Swiss National Bank, I think it was last week. Of course, they had surprised the market by removing a peg in the currency. I mean, there's a lot of surprises going on in the markets right now from central bankers. We're not known for surprises.
So we seem to be back to the days of central bankers trying to surprise the market as opposed to central bankers trying to calm the markets. So after the crisis of 2008-09, central bankers, especially the U.S. Fed, tried to calm the market. So they would telegraph well in advance what they were going to do. They were going to reduce rates, keep rates low for a long time. They were going to buy back treasuries, mortgage-backed securities, keep on doing it for years and years. And then they told us when they would start to slow down this process, and they told us when they would stop this process. And then we thought things would remain as they were, and we got lulled into this, predictable central bank policy. And then suddenly the Swiss, the Danes, now the Canadians are, jolting us into changing, being awake and reacting to all kinds of things. So
oh yeah, and we're awake. We're paying attention now for sure in terms of what's going on. I think everybody's fairly awake right now too. I want to ask you, I mean, is this just, are we laying the groundwork for more volatility? I mean, you said, the job of the central bankers seemed to have been calming markets. That seems to have switched. So what does that mean for volatility? Because this is your wheelhouse. What do you expect to see?
So basically the U.S. Fed mainly succeeded in calming markets, and for from 2009 until let's say last September, we had very calm markets. So we had roughly 2/3 of the normal volatility, and then with the end of quant easing in the U.S. and uncertainty about whether it would start in Europe and how well it would work in Japan and so on, then markets started to become a little more anxious and volatile. And basically what we see, since September is more or less normal volatility. So it's not really high volatility, it's higher than it was, but it's, if you have a longer view, it's really normal. We're back to normality. The VIX, which is an index of implied volatility, it's also called the fear index by some people. It's about, trading at about 18, 19 in that range. That's just barely above long-term normal, which is around 16.
Yeah, so
we're back to...
We're back to, you're saying, normal levels. We're just pulling up a chart actually right now, Jean, of the 10-year VIX. And so if I hear what you're saying too, is like, we're ramping up to almost normal levels of volatility, but I mean, do you expect to get higher levels of volatility, like 2008 volatility coming anytime soon?
Well, 2008 was extreme volatility, so we've hardly ever seen that. I don't expect a VIX of 65 anytime soon, but a VIX of 25, a VIX of 30 for short periods of time, for sure. Every time there'll be anxiety, there'll be surprise decisions, the VIX will go up a little bit and it will come down. That's just the way, that's normal.
Yeah. Now, I know for some people, and again, I'm a big believer in there's no, right or wrong or good or bad. It's just things happen and different people play things in different ways. So traders love volatility. They want to play with it. They want that to happen. But for those people who don't, that don't want the volatility in their portfolios, they don't want to worry about what's happening. You've designed some low volatility strategies at TD. And tell me a bit about the reasoning behind that. I mean, you've done some work on the risk-return relationship between low volatility and high volatility stocks.
And basically, I couldn't find much of a relationship, at least in the long run, between stock market or stock return volatility and average or stock return. So basically, if you believe in the capital asset pricing model, it says that higher volatility stock, riskier stocks, more cyclical stocks should deliver higher returns on average because they're not very nicely behaved stocks. I mean, they tend to go down at the wrong time and they move more. So investors who like predictable returns, who like positive predictable returns, should demand more higher returns for these things. Unfortunately, when you look at historical patterns of volatility and returns, you don't see anything like this. You see basically a flat relationship between volatility and return. So it means riskier stocks over the long run have delivered about the same returns as less risky stocks.
So what have you just sorry to interrupt, but so what have you done then in terms of how you construct your portfolios? I mean, what do you look for, and what's been the result?
So basically, we've decided to build portfolios that are fully invested in equities but take as little risk as possible. So we're trying to build portfolios that exploit, that invest in less volatile equities but also exploit diversification, so benefits, and hence invest in various industries, various stocks in a way to reduce risk as much as possible. Unfortunately, we cannot reduce it to zero, but we can shave off somewhere between 25 and 30% of the risk, which is pretty good.
I know that I was going through some of the work you've done, and one of the things you've pointed out is that compounding it works more in your favor when you are holding stocks of low volatility. So
it's well known that if you lose half your money, you need your capital to double up to come back to par. So, you have a return of minus 50%, you need a 100% return to get back to even. Whereas if you lose only 5%, then you only need, 5.3% to get back to even. So, if you don't lose much, you don't need to gain it back. And so that's basically the one of the big benefits of low volatility investing. What you don't lose, you don't need to gain back.
What do you expect to see, I guess, if you were to, and again, I know that, you can't make predictions specifically, but when you look out over the next, I don't know, say 2 to 5 years, do you see your strategy being, obviously you think it's a good one, but do you see the volatility really going to be working against people in terms of trying to manage these markets?
So for sure, with the end of, the U.S. Fed quant easing program, and with various problems in Europe and, trying solutions and so on, we expect volatility to come back to normal levels, which are higher than what we experienced over the last 3 or 4 or 5 years. And so I basically expect volatility to be in a normal range with a few crises and, and thus sometimes higher. And that's not a very good experience for investors. So basically trying to take on as little volatility as possible is the right strategy if you want to grow your assets.
Jean, such a great pleasure having you with us. Thanks so much.
Thank you, Kim.
Jean Masson, manager of the TD Low Volatility Equity Fund and a whole suite of low volatility funds, joined us from Montreal. He's the head of quantitative research at TD Asset Management.